Hi guys, and welcome to this TA deep dive session on patterns. Yeah, I was wondering for quite some time how I should approach this topic. It's huge. It's super important, relevant, and it's right at the core of technical analysis. So yeah, I took some time to reflect and think how I should do this and how I can create value that goes beyond what you already know and what you can find on the web already. I mean, there's plenty of stuff around patterns. And yeah, I was thinking about how to improve that knowledge, how to bring it to the next level and come up with some very valuable stuff. And I think I found a good approach. I will split this into multiple sessions because it's simply this big of a topic. I will need some time to explain all the details. This will probably be my greatest challenge yet. Yeah, I really hope it's useful to you. Please give me feedback. It's super important to me to receive feedback and to get to know what you guys think. Yeah, and so I can adapt on the fly. I mean, it will be split into multiple sessions. So if you think in part one, this is not going where you wanted to, it's not useful to you, then let me know and I can adjust. I can still change the contents, the focus, where I put the focus on. But I think the plan I have right now is very good in order to give you a very holistic understanding of patterns and to really make you understand what is happening in the market and not just to recognize patterns, but to really understand what is happening there and how to read the price action in patterns. This is where I want to go and the ultimate goal of this series on patterns. And let's see if it is feasible. So to start off, in part one, I'm going to discuss some very basic aspects to patterns. I think most of that is probably already well known to you. If not good, then you will learn something new. If it's familiar to you, no problem. It's good to repeat this, to bring this into a structure. And yeah, I think you can't repeat this basic stuff often enough because it's very, very important. And maybe you can get a different view on these basic aspects because I have my own focus. Yeah, I'm trying to emphasize certain aspects because they are especially relevant. And yeah, let's see how it turns out. One last thing before we start. If you're new to trading and if you're a complete beginner and you don't know what patterns are and what patterns exist, which kind of patterns, then I would suggest you, before you take this course or before you listen to this session, I would recommend that you go ahead and look up the basic patterns there are. I mean, there's a lot of stuff on the web. You can go to Investopedia and look at the explanation of what patterns are. And there are also examples. You can go to Google and simply type in technical analysis patterns, and you will find hundreds of images describing different types of patterns and what kind of price action to expect, the attributes that are relevant to these patterns. You can do this, and this will be very helpful in order to understand what I will be talking about in a few minutes. So I would recommend to do this first and then come back to this session. So it's easier to follow and understand what I'm talking about. In general, I want to try to avoid talking too much about the basics. I want to focus on the really important stuff that is insufficiently explained in trading courses and stuff. I have to do this because I want to create unique value, and I don't want to repeat what 100 or 1,000 people before me already explained in detail and with 30 years of experience. This is not something I want to do. I want to give you a very unique perspective on the things, a unique understanding, and I want to explain things in context of price action and not just repeat basic definitions and such. So for all beginners, go ahead and look up the pattern types there are, what they represent, how they look like, read some basic descriptions, and then come back to the session and you will see that it will make much more sense. Okay, let's start by looking at some very basic facts about patterns. And I'm going to explain them one by one. The first one is that patterns can be read or interpreted differently. So they are actually not the same for everyone. This means that there are a lot of points that contribute to patterns being perceived differently. Let me get some space here in between those points. Okay, so as you can see, patterns strongly depend on your methodological approach. That means depending on how you actually find, or the method you use to find patterns, to identify patterns, can of course be different to the method that is being used by someone else. And this means that you and maybe this other person look at the same chart and you discover different patterns. Maybe you discover the same patterns, maybe different patterns, maybe the same pattern but in a different alignment or position or whatever. So the method and the approach you're using is very, very important to determine what kind of patterns you come up with and how they must be interpreted and read. The second point is that patterns are time frame, chart, and ticker specific. This means that a pattern on the 2-hour chart doesn't necessarily have to look the same on the 1-hour chart. Even though there's more data and not less data, the pattern doesn't necessarily have to persist across time frames. So you might run into problems if you want to compare things and you look at different time frames and you can't recognize these things anymore because the candlesticks, for example, that you're looking at are aligned in a completely different way, and where candle bodies are on a lower time frame, there is a wick on a higher time frame, and depending on whether you're looking at wicks or not, this is the methodological approach again, the pattern can turn out completely different. So there are huge differences in the approach that you can take to find patterns, and the time frames play a big role in that. But also the chart itself. So depending on, of course, what kind of asset you're looking at, and the ticker you're using. So even if you're at the same asset, like Bitcoin, for example, and you're using 3 different exchanges, one that is driven by perpetual contracts, for example, and one that is spot-based, like Coinbase, for example, and maybe a low volume exchange for Bitcoin, then you will see there are differences on the chart, of course. Mostly they are subtle differences. They don't have any grave impact, except maybe for the Kraken exchange, which likes to produce extreme wicks from time to time. But in general, there are subtle differences that can lead to patterns not emerging or even getting distorted and dissolved and whatever, broken. So this is also a point, because all the traders are looking at different charts, different time frames, different tickers, they are using a different methodology to find patterns. So there are lots of factors that play into this, why they are perceived and discovered and identified differently. But there is even more to them, because patterns can be both bearish and bullish. This means there are patterns that are often viewed as classic bearish patterns and classic bullish patterns. But there are also patterns that can be interpreted in both ways. That do have attributes from both bearish and bullish sides, and there can be signs of maybe indecision in a pattern. So there's also some kind of bias that plays into this, how a trader reads the pattern. And this comes on top of the methodology and the technical issues that comes on this comes on top, that a pattern can be read maybe in a completely different way. You can consider this pattern to be bearish. Another person can consider this pattern to be rather bullish. So yeah, this is something that also plays a big role in this. And then there is one aspect I'm going to explain and go deeper into this in the second part of this pattern series. Patterns can transform. So pattern transformation is something that you will probably never, or maybe if so, let me know. I've never seen anyone talking about this, that patterns actually have the ability to transform themselves into other patterns. So patterns often are in a process of transforming themselves to become a different one. And while they are in the process of transforming, for example, when you got a triangle and this triangle is transforming into a parabolic move, which often happens, then this is something that while it is in the stage of transformation, it can be read in both ways. It can be seen as a parabola emerging, but it can also be seen as a triangle because it's still in range. Price is still in the triangle range. So there's this kind of ambiguity you do have in identifying and reading patterns as well. And as you can see, just talking about the first aspect, that patterns are highly difficult to grab, to define, because there are so many factors making it difficult to come to a consensus on what kind of pattern you're looking at and if it's bearish or bullish. This poses some problems. It gives us troubles explaining our TA, and as you maybe know, when you see a chart from someone else, you ask yourself, why is he or she looking at this kind of pattern? Where did it come from? I didn't see it, or I see something completely different, and this makes it very difficult to handle this. So aspect 2. It means that patterns can be identified. This describes the ways you can identify patterns by. And this is a very important point. And in this deep dive session, I want to talk about this second aspect more in depth. But I will probably come back to this in the following sessions as well, because it's simply this important. So patterns can be identified using various methods. The first one is classic pattern recognition. This is what, if you're new to trading and you're learning about patterns, this is the method you probably use. I would be surprised if you did it differently. Most beginners use pattern recognition. Even pros use pattern recognition. It's not that it's just it's an easy but maybe unreliable method. That's not the case. It is reliable, but in general, pattern recognition means you're relying on your ability to discover patterns by visual appearance on the chart. So you're looking at price action. Let me zoom into this here, Bitcoin. And so you're looking at the chart, and since you are often dealing with simple geometric shapes and stuff here, rectangles, triangles, curves, arcs, whatever, it is rather simple to go by pattern recognition and to find something on the chart, like, for example, this triangle here. It is easy to find this because you can, simply by looking at the chart, you already can see that these highs form a line and that these lows form a line, and then your brain automatically completes the shape and you come up with a triangle. So this kind of process, this pattern recognition, the technical process, is often used to find patterns. However, there are other ways. And the second method you can use is contextual price action analysis. And this is something that I think is completely undervalued or even unknown. This is the This is the upgrade to the pattern recognition approach. So you can use pattern recognition, of course. You can say, for example, in this case, we are, okay, this is not a triangle. We are in this rising wedge-like structure. But you can also not do this, and you can go ahead and see what price is doing here. Price is making a high. It is retracing, making a low. It is coming back up. It is making a high that is slightly above the previous high. And now you can see that you try to read what the market is telling you. This means that you see that price action in this case is weak. Why is it weak? Because after achieving this previous high, it didn't manage to really rally higher. It failed soon after achieving this high, which means it's weak. So it is getting weaker. And then you see another retrace. And it's going back up. Of course, it's making this higher low, which is a good sign in general that there's strength, there are buyers here. However, you see this weakness up here. And then you look further and you see, once again, after achieving this high, it is making another high. So another high that is slightly above the previous one. So this weakness still persists. And now you can see that here this low was dangerously close to this low. So you see the weakness is intensifying, and the process of this price action getting weaker is what I call contextual price action analysis. You are trying to analyze price action in a way that tells you what the market is actually in, what kind of state the market is in, the context of this price action. And when you're doing this, you're doing the same as when you're trying to find patterns by doing pattern recognition, applying a pattern recognition technique, because a rising wedge by definition tells you we have weak price action and it will probably break down because momentum to the upside is running out, and we will probably see a breakout to the downside and maybe even a reversal or something of that kind. So we're talking about the same thing here. But the one approach is you're looking at the visual appearance, and the other approach is you're looking at the context of price action and what it is doing and what it is telling you. And my goal is in this session, not in this particular session here, but in this course and over time with multiple sessions, I want to teach you the ways of doing pattern analysis by applying both methods. Basically, you're using a two-layer approach to your pattern analysis. The first layer is pattern recognition. The second layer is contextual price action analysis. And if you put both on top of each other, your trading success, in theory, of course, it always depends on your actions, but your trading success based on patterns will experience a boost because the reliability of your calls will increase significantly. This is what what my goal is with this kind of course. There's a lot to explain in terms of contextual price action analysis. We have to go through all the patterns, and I will tell you what I know in terms of what to look for in price action, about strength and weakness, about certain candlestick patterns that can be identified within patterns. So there's much more to that, but also there's there's also the transformation aspect, and I will tell you how to read transformation processes and how they play into this contextual price action analysis approach. This is very advanced, I would say. I would consider this to be an advanced approach, but it is. I think it's absolutely worth it, and you won't find many courses going this far. It's actually something that is not being explained much because most of the traders stick to the pattern recognition, and this is why a lot of calls fail. They call a head and shoulder, like this one. Let me see. Like this major head and shoulder. A lot of people rely on pattern recognition. Look, what they are doing is they look at the charts. not everybody, but a lot of people, they look at the charts like this, and then they see, their brain tells them there's a shoulder, there's a head. Oh, I know this pattern, it's a head and shoulder. So you go ahead and you start drawing this thing like this. So then you have your head and shoulder based on pattern recognition. But is it really reliable? Can we expect this pattern to break down like this because this is how it came to be? Is this what we are really looking at here? Or is it something different? And this is a very good question. And this is a prime example for why contextual price action analysis is extremely important when you're trying to catch really significant trades. For example, like this, when your idea is you're shorting this on breakout with a target of 10K, sure, but you should be aware of the probabilities that this kind of trade has. So this is the reason why we are using contextual price action analysis. And then we are starting to read into this structure and look what is happening here, what is happening here, what is happening here. Is it actually what a head and shoulders is supposed to be? Because a head and shoulder has a message. It tells you we are in distribution. It tells you the entire structure is in a bearish range, like this is a bearish range. And it also tells you that this is that we are in first profit taking here. We have the big boys unloading their positions up here to the euphoria that is in the market. So you have this FOMO going on. Everybody's buying because it's hyped to the moon, up only. And then you got the big boys that are unloading their positions into this pressure to the upside. And this is why we are seeing a head structure to begin with. So there's a reason why a head and shoulder is a head and shoulder, and you have to dive into this. Why is there a left shoulder? Why is there a right shoulder? Why is there a head? How do they have to look like to make them valid head and shoulders? There's a contextual analysis to be done, and if you are able, if you are capable of doing that, you can distinguish the good from the valid from the invalid patterns. You can find out if this is a true head and shoulder or not. You don't have to rely only on something that you see on the chart, because you understand what is going on here. This really looks like a perfect head and shoulder in terms of pattern recognition. You have this retest of this level. As you can see, it's on the perfect hit the perfect level. We have a sharp rejection. We have a well-rounded top structure. So there are a lot of factors that are telling us this can actually be a head and shoulder. And I'm not surprised so many people are talking about this and looking at this, and even professional analysts are looking at something like this solely based on pattern recognition. This is fine. You can do this. However, there's still a risk to it. We don't know if this is a valid head and shoulder. And I will teach you the criteria, the requirements I'm using to identify if a pattern is a pattern. So we put on top the pattern, on top of the pattern recognition, we put the contextual price action analysis and start to analyze what the structure represents, if it is actually what we think it is. And then we can come up with much better scenarios, expectations, targets, whatever. It will be much easier. Of course, it will be more work to get there. It's much to learn, but you will see that trading and an analysis, TA, makes a lot more fun if you really understand what's going on. If you really understand what is happening. Of course, it's not always possible. I know that there are times of uncertainty, of high uncertainty, but in many cases, it's possible to completely read the situation and to know exactly what price is doing. And once you're at this stage, you will feel very relieved. You will have less stress, and your trading style will become much more easier to handle, simplistic, but still very successful. So this is something I want to do here. And for this, we have to talk about all the different patterns there are. their attributes, what we can expect from them. Yeah, we have to go very deep into this. And it will take a few sessions to do this. I certainly won't do this in one swoop. Okay, so point 3. Patterns are at the core of price action analysis. They are at the core because most price action can be attributed to one or more patterns. So when you got, for example, this kind of price action down here, so now you're able to attribute this to multiple patterns. For example, you can look at the pattern that is playing out here. You have a trend line, and you have this kind of ceiling here, as you can see. And you see that we are in some kind of a parallel channel running through, which ultimately gets retested, and we go higher. So this is the confirmation that this channel is broken in a bullish way, and we continue higher. But you can also look at the same thing from a different perspective. And I just have to go to a different chart. And now let me take the line chart, and here you can see that the shape is now different. We have still some kind of channel, but it's running completely different to the larger one. I didn't change anything. I'm just using the line chart, which represents the candle bodies instead of the wicks, without the wicks. And I'm looking at the same bit of price action on a 3-day chart. If I go lower to the 1-hour chart, for example, go back to this one, we can see that there is another pattern in this in this area. Let's connect these highs here with each other, and you see with this trend line, now we have some kind of ascending broadening wedge going up here, and is invalidated at this point because it didn't reach the top. But as you can see, there are multiple ways to approach this and to find different patterns. This is very related to the point 1. Depending on the perspective you choose, what you are seeing on the chart. But it's also the possibility that this price action is part of this broadening wedge, while it is still part of, while it is also part of this channel structure and this channel structure. So we have multiple pattern effects on top of each other. And at some point it becomes very complex and difficult to really get a focus on and narrow down the possibilities of what can actually happen here in this range. So patterns are at the core of price action analysis, because wherever you look, it doesn't really depend on the level or area. You will find patterns everywhere. This is they are present everywhere. They form everywhere. This is one of the core aspects to price action. Then point 4, let me get rid of this first. Point 4, patterns can stack and be nested. This means that you can find patterns within patterns. An example I used in one of my videos, I think in the pressure zone deep dive session, was this kind of triangle we had here. Maybe I'm going to the 4-hour chart. 6. Okay, so let's take the 6-hour chart. You can see that we have this kind of triangle-like structure, and there are different patterns within this structure. So, for example, I can let me take this one. Here you can see we have this kind of structure here. You can also draw it differently. So you can find nested patterns or stacked, however you want to call it. They can stack. You can have the same pattern multiple times within each other, stacked or on top of each other. It can look very funny, but all of this is normal price action. let me see if I find a different example. For example, here you got some kind of some channel structure. You have this channel structure here. Yeah, so you can look at patterns from all these perspectives and dissect price action very precisely by looking for patterns. Point number 5, the frequency and reliability of pattern types. This depends on the market environment. So this is already referencing the interpretation of patterns, so how they should be interpreted, how they should be read in terms of when we want to find the perfect trade, or if we want to find trade setups, or if we want to distinguish bearish from bullish patterns. There are some rules we have to keep in mind, and yeah, there are patterns that occur more often in bearish environments, and some patterns that occur more often in bullish scenarios or sideways scenarios, but also their reliability is also changing. So this is a bullish market environment, and there are structures that are actually more bullish, or can be interpreted in a more bullish way. For example, we have this falling wedge structure here. You can see when I look at the line chart, it makes more sense. So we have this falling wedge pattern structure here, and as you can see, this is turning out to be the point of continuation where price continues higher. In general, a falling wedge is considered to be more bullish than bearish. However, if you see falling wedges in a bearish environment, let's have a look. Going to the lower time frames. Let's see. So we got this one, for example. Also some kind of falling wedge. It is falling a little bit faster than the one we looked at before. But as you can see, we don't have bullish continuation higher in this case. We simply have a tiny breakout and then a retracement to the breakout level, and then a slight up move that didn't even reach this top of the structure, and then continuation lower. So in this case, you could consider it bullish because there was a move to the upside. However, this is not what we would expect in this case. The reliability and the power of this pattern is, yeah, it's reduced. It's not as effective anymore as it was in a bullish environment. And this is something that we have to keep in mind, because patterns, if you're used to trading bear markets and now you're trading a bull market, you will be surprised by how the patterns behave, how differently they suddenly behave. Behave. This is something that is normal, but it is difficult to grow accustomed to, because it's sometimes it's going against your logic. What you have a different expectation. You see the breakout, and then you say, hey, we see a retest, and then continuation higher. But in this case, okay, you could say this still worked out because it went higher from here. You could have longed this, for example, and made some profits. But there are other examples I will have to find, because I didn't look at the charts before, but I know there are these types of patterns. For example, this one. This is more of a channel, but it can also be drawn, as you can see, it can also be drawn as a falling wedge, and it is breaking to the downside. This is what I was, is a better example for what I was talking about. The environment tells you a lot about how reliable a certain pattern type is. And if we do contextual price action analysis, we don't run into these problems because we can read the situation instead of just a structure. It is appearing as one. Some patterns represent developing pressure zones, and some others represent pressure release zones. And this is very important. In my TA deep dive session on pressure zones, I'm talking about how you can find pressure zones by looking at patterns. Let's take let's take something different in the past. Let's maybe look at this one. Here you can see we have this trend line that is somewhat holding price. We have kind of channel structure here, but you can also draw different patterns. You can, for example, if you make a trend line here, draw a trend line here, and you have this trend line. As you can see, price is being is trapped in this narrow zone. It is becoming narrower. Support and resistance entities are converging with each other. So it is a pressure zone, and we can expect volatility when price finally breaks out of this pressure zone. And this is what happens here. But a pattern can also be the opposite. The opposite. For example, this one. You have this trend line, and you have this trend line. And as you can see, this is some kind of, it's similar to a megaphone, a broadening wedge structure, symmetrical broadening wedge. It would be perfect if this went down, but it's not. So it's similar, but it's not the same. But it is okay to convey the message. As you can see, we start small. We start in a pressure zone, and price is fighting its way. It's actually becoming more volatile, more aggressive to the upside and downside, and pushing resistance and support further away to actually get some space here. This is pressure release. So the pressure is being released on these moves. Whereas in this case, pressure is being increased. It's being generated towards the peak of this structure. And then when price breaks out of the pattern, this pressure is released and we see volatility and strong moves. This is something that we have to keep in mind as well, because it plays a huge role in analyzing patterns and the situation in contextual price action analysis. Okay, I'm talking very much, but this should be it for this, for the introduction. These are the aspects that we will look at more closely, more carefully. And I think I will release this part as an introduction, and I will release the part about contextual price action analysis when we dive deeper into patterns and how to read them, what is happening there, as well as pattern recognition, of course. But this is something that you should already be able, that you should be capable of already. Then I will put this into a part 2, and I will try to record these sessions with not this much distance in time. So I want to finish, or I want to proceed with this series as soon as possible. Because I think it's very important, especially when, just in case we are entering a true bear market, which is not unlikely at this point. It is very important to know about this stuff, because bear markets are completely different than this bull market price action. The relevance of patterns and the knowledge about what kind of patterns we can expect, how bullish and bearish they are, what kind of traps there are, this is of utmost importance. It's to survive in a bear market. If you want to trade in a bear market, you have to learn all this stuff. Trading the bull market it's different. The bear market requires more TA knowledge, and the bull market requires good risk management. Of course, the bear market too, but the bull market as well, because there's extreme volatility going on. A lot of traps, failed breakouts, and all this stuff. And in bear markets, you have cleaner TA once the the price action has calmed down a bit, volume has decreased, then you have very clean price action, but you have sudden surprises. And these sudden surprises are part of contextual price action analysis. So you can see these things, what people call scam wicks and so on. Yeah, this is something that you can see in advance. It's not impossible. Okay, but it's of course it's not yet certain that we will enter a bear market. It's not looking too bullish at the moment, but yeah, there's still a possibility. I still don't think this is a top, but we will see how this plays out. Okay, yeah, I hope this introduction was useful, and see you in the next session, in the first real in-depth session. Remember, if you're new and you haven't yet done this, learn about the different types of patterns, because you will need it in the next session for sure. And I will, yeah, the session will require you to know about patterns and what they represent, because I'm not going to explain the basics of the basics that you can read everywhere. This is something that you have to know before going into this. Okay, see you next time. Bye-bye.